Hello friends, in this video I will be taking two topics, key rate duration and empirical duration. We have already covered yield based duration and curve based duration and the second order effect, their respective second order effect, convexity calculation. Then why we need this additional key rate duration and empirical duration, and how these are improvising the previous versions. In case of yield-based duration and convexity, we have assumed three assumptions. First assumption, that cash flows are certain, not about the credit risk. What we are talking about is the number of cash flows and the amount of cash flow. So, if it is a 5-year tenure bond, then the bond will give coupon at the end of each year, and at the end of 5th year, bond will pay the redemption value. That was fixed. What if these number of cash flows decreases or changes because of some embedded contingency provision, embedded option inbuilt into these bonds, call option and put option, which gives rights to but not obligation to its holder. In case of call option, to issuer to call the bond back for early redemption, and in case of put option, to put the bond for early redemption, and the right is with investor. And whether they will exercise their right or not, it will depend on the situation between market interest rate and coupon rate. If market interest rate is higher than the coupon rate, to increase the return, investor will go for early redemption by putting his bond for early redemption. In that case, the weighted average duration, tenure, will reduce. And in case if interest rate goes below the coupon rate, then the issuer will refinance their bond with a new issue at a lower returns. So again, the duration will reduce. To improvise that first limitation, that cash flows are certain, we calculated curve-based duration and curve-based convexity. So rather than using sensitivity of bond price with respect to change in the yields, we have used sensitivity of bond price with respect to change in benchmark yields. Because in case of embedded option, bonds with embedded option, the yield to maturity or yield to call or yield to put are one of the many events. There is no defined specific yield. So Macaulay duration, modified duration become one of the case, not all cases. So that is why we use effective duration. So first limitation was cash flows are certain, got improvised by using the effective duration. There is a second limitation in case of yield duration, and now that second limitation is there in the curve based duration also. In both yield based duration, modified duration, and the curve based effective duration, we assume that yield curve will move in a parallel fashion. If yield of first year is increasing by 5%, 1%, yield of 10th year is also increasing by 1%. And if they are decreasing by constant value. So there is a parallel shift in the yield curve, which may not be true. Because the changes in the yield curve at their respective timing is depending on the demand and supply forces of the money at those point of time. So if there is a higher demand of money at 10-year than the 2-year period, then the rates will be different for 10 year. There will be higher yield requirements. Here, what if there is a non-parallel shift in the yield curve? Then the modified duration and effective duration both will not be the correct measures, risk measures. So here comes the third type of duration calculation, that is the key rate duration, which will calculate the sensitivity of the bond price or the bond portfolio with respect to changes in the yield at a specific point of time. Let's say the remaining points on the times that yield curve will stay constant. Only one period yield is going up and down, and it's coming back at the same place. So that if we go by graph, what will happen in case of non-parallel shift. In case of non-parallel shift, if it is a normal yield curve, this is your tenure, this is your yield, and we are talking now about benchmark yield. We understood that it's better to use benchmark yield as the base for calculating the durations. So it is the benchmark yield. So if it is a left to right moving upward yield curve, what if only at one place the yield curve is moving higher or down, and the remaining tenure yield are staying constant because of changes in the demand supply forces of money at that specific point of time, fifth year? What will be the impact on the bond portfolio's value? That will be calculated using key rate duration. Now there is a third limitation also, that yield of a bond is sum of two things: benchmark yield, which include real risk-free rate of return, and inflation premium, and the second is spread, which represent your credit risk premium, liquidity premium, maturity premium, and taxation factors premium. So what we assumed in case of modified duration as well as curve based duration, that this benchmark yield and this spread, which the sum of which is equals to yield of the bond, they are not correlated. So if benchmark yield is moving up and down, the spread is going to stay constant. So spread will have no effect on the changes in the yield, which may not be true in some cases. So that will be improvised using the last part of the duration calculation, that is empirical duration. What are the LOS we are going to cover here? The LOS is, first, define key rate. First of all, we have to find out what is key rate, define, and then describe its use. We will use key rate duration to find out how we can change the portfolio composition to increase the returns for the investor or decrease the losses for the investor. Then describe the difference between empirical duration and analytical duration. So we do not have calculation of empirical duration, which we cannot actually, because statistical model will be required in case of empirical duration. What is analytical duration? The duration calculations done using mathematical models. MAC duration, modified duration, effective duration, and your key rate duration. All are analytical duration, that is duration calculated using certain mathematical model, whereas in case of empirical duration, statistical models will be used, which is not in our course. We have to just describe the difference between these two. So let's go for the calculation of key rate duration. First of all, how to calculate this key rate duration? What it represents? It represents the duration effect for a specific change in the yield at a specific maturity. Not the whole curve is shifting. So there is a non-parallel shift. What it's saying? The effective duration measure. This is about talking about effective, the previous one. Curve-based duration measures the bond sensitivity to change in the yield curve for a parallel shift. Key rate duration, also called as partial duration, measures the bond price sensitivity to a change in non-parallel shift. Only changes are happening at a specific maturity time. So it isolates the price response of a bond to change in rate of a key maturity to a key maturity on the benchmark yield curve. Now we are taking benchmark yield curve as the base, not the yield of bond. We understood that bonds with embedded option should consider sensitivity with respect to benchmark yield curve, not the yield of bond only. Thus, of course, the sum of key rate duration must be equals to the total effective duration. Why? If a bond is of 3-year tenure, year 1, 2, 3, only 1 year yield is changing, of course, the bond price will change. If only second year yield is changing, of course, the bond price will change. Only third year yield is changing, of course, the bond price will change partially. But if all the three yield at all the three places, all the three time, that is tenures, 1 year, 2 year, 3 year tenure, changes by an equal rate, of course, the overall change in the bond value will be equals to the sum of individual changes. How it is equals to sum of the individual changes, we will check in the mathematical calculation. So key rate duration identifies the shaping risk, whether the bond yield curve is, price yield curve is changing the shape or not. If it is changing, it's better to use the key rate duration. How to calculate key rate duration? Same formula. The calculation of risk is change in the percentage change in dependent variable. Risk is quantified using the formula percentage change in dependent over percentage change in independent. Here in case bond price is changing, so sigma delta PV, that is change in PV over P with respect to change in rate at a specific point of time, that is at K, its kth key period, kth key rate which is changing, that is the rate at a specific tenure which is changing. So this is your key rate duration, key rate duration. So now let's go for some numerical calculation and how portfolio manager is going to use the key rate duration to increase their returns for the investors. Let's go for calculate the modified duration, key rate duration for each bond in the portfolio, and all bonds have, now assuming that all bonds have same benchmark curve, same government par curve is used for the benchmark as a benchmark for these bonds. So let's go for the calculation of modified and key rate durations. So we have 3 bonds in our portfolio. One is of 2-year tenure, 5-year tenure and 10-year tenure respectively. Then the coupon rate, to make it easy, I have kept it 0%. So it is a 0 coupon bond. And in case of 0 coupon bond, these are 0 coupon bond, and for 0 coupon bonds, your Macaulay duration, MAC duration is equals to the tenure. We have annualized yield, so modified duration is equals to MAC duration divided by 1 plus R. Par value is available, so let's start the calculation of modified duration. What it also says that, it says that your expected changes in the benchmark curve at various maturity, that is at the second year time, 2-year time, the yield is expected to go down by 100 basis point. At 5-year time, yield is expected to go down by 75 basis point, and at 10-year time, the yield is expected to go down by 25 basis points. So it shows that since they are not equal, it is a non-parallel shift. It's a non-parallel shift. If it is a parallel shift, then all the changes in the basis point, expected changes in the basis point will be same at all tenure. So let's start the calculation of first modified duration and the overall portfolio duration. What it says, we have 3 bonds. I have already started the calculation solution. I have done some partial working. So there are 3 bonds, tenure 2, 5 and 10. Yield is there. Macaulay duration is equals to your tenure. Modified duration is equals to Macaulay duration divided by 1 plus R that I have got, and the price. Now how I have calculated price? Price is equals to FB upon 1 plus R to the power N, because it's a 0 coupon bond. There is only one cash flow. So 100 divided by 1.02 square is equals to 96.1169. Then 3%, 1.03 YX5 reciprocated into 100. It is the second bond value, or you can use the TVM function, that is the third row in the calculator. Now price I have already calculated. So all are of 100 million, same par value. So valuation will be 100 into 96.1169 divided by 100 and so on. So everything is same number. The one bond is of 96 rupees. So all bonds will have a value of 96.1169 million, etc. Now I have already calculated the weights also. How to calculate weights? Weight is the value of individual bond divided by the overall value of the portfolio. So weight is also there. Now how to calculate, first of all, bond portfolio duration. Portfolio duration. Portfolio duration is equals to sigma weight into respective duration. What we will be doing, 0.3846 multiplied by 1.9608 plus 0.3451 plus 4.8544 plus 0.2703 multiplied by 9.6154. So overall it is equals to, let's check it out, 0.3846 multiplied by 1.9608. Next, 0.3451 multiplied by 4.8544. And last, 0.2703 multiplied by 9.6154 plus, hold this, one mistake, 0.3846 multiplied by 1.9608 store 1, 0.3451 multiplied by 4.8544 store plus 1, 0.2703 multiplied by 9.6154 plus equals to, so overall duration is 5.0284. The overall bond portfolio's duration is equals to 5.0284. What it shows? This 5.0284 means that for every 1% change, every 1% change in the yield at all places, 2-year, 5-year, 10-year, the bond value will change in the, of course, in the reverse order, inverse manner. If yield increases, price will go down, and if yield decreases, price will go up by 5.0284%. But condition is at all time period, the term to maturities, the yield should increase by a constant change, parallel shift. Now, only if one period, that is second year, yield increases by 1%, what will happen? How to calculate it? Very easy. What we are going to do? We are going to multiply the weight with respect to modified duration. The portfolio will change by that value only. So what we are doing, the key rate is 0.3846 is the overall value of the portfolio, multiplied by, it will change by 1.9608. So this is going to give us the key rate duration for second year period. So this is 0.3846 multiplied by 1.9608 equals to 0.7541. This is the key rate duration for our portfolio for 2-year time to maturity. If 2-year time to maturity yield only 2 year, not the other point of time, only 2-year yield is changing by 1% up or down, the bond price value will go down or up in the reverse order by 0.7541%. Next, 0.3451 multiplied by 4.8544. The key rate is 1.6753, and the last one, 0.2703 multiplied by 9.6154, 2.5990. Overall summation is equals to 5.0284. So individual change as per the changes in at their respective time, the sum of those changes should be equals to the overall change. So if 1% increases only at 2-year period, the bond portfolio should change by 0.75%, keeping other two levels constant. If 5-year tenure yield changes by 1%, your portfolio will change by 1.67%. If only 10-year tenure yield changes by 1%, the portfolio value will change by 2.599%. And if 1% increases at all point of time, the overall portfolio should increase by or decrease by 5.0284%. So this is what they are saying, that the sum of key rate duration must be equals to effective duration, because we are using benchmark yield curve. So it is modified duration is not is equals to effective duration. Now, what it says, if the expected change in benchmark curve at various maturities are as follows. 2-year it is changing by down, it is going down by 100 basis point, 5-year it is down by 75 basis point, and at 10-year it is down by 25 basis point. What will be the impact in the change in each bond value? First of all, what is the change in the value of each bond first of all? So if only assuming only 2-year yield is down by 100 basis point. So earlier it was how much? 2%. Now new yield will be equals to 1%. Bond price will change. Of course, the PV of B, A bond will become 100 divided by 1.01 power square. It's a zero coupon bond. So it is going to be 100 divided by 1.01 square equals to 98.0296. Bond B and C will stay same. 86.2609 plus 67.5564 because their maturity yield is not changing. So 86.2609 plus 67.5564, these are in millions. 67.5564 plus 86.2609 equals to 153.8173, and the overall bond portfolio will become 98.0296. The value of portfolio will become from 249,99342, it will become 251.8469. So what is the percentage change? Let's calculate. Divided by 249.9342 is the change in the value, minus 1 multiplied by 100. That's the change. New value upon old value minus 1 old multiplied by 100. It is giving a change of percentage change in the portfolio is equals to 251.8469 divided by 249.9342 minus 1 whole multiplied by 100 is equals to how much? Positive 0.7653, which is almost equals to this 0.7541. That slight difference is because of the convexity effect. Because of convexity effect. And in case of key rate duration, we are not going for convexity calculation, only duration calculation. So this we can do it for bond B also. Change at the 5-year tenure, change yield by 0.75 basis point and recalculated, it will be almost equals to 1.6753, a bit higher because convexity value is not added in this. Convexity is always added. So the actual valuation will be a bit higher than change will be a bit higher than what is given by the key rate duration. So now how to use these key rate duration to identify where we can shift our bond valuation portfolio value to increase the returns for the investors. As a portfolio manager, what changes you should make in the portfolio? So we have calculated key rate duration and now we have got expected changes also. Assuming these expected changes will turn true, what will be the change in the value of individual bond? So what will be the change in the individual bond? So change in the individual bond is negative key rate duration, inverse relationship, multiplied by change in the kth key rate. So RK, changes in the RK. So we have to just multiply the respective changes. So changes in the B bond. Changes in the bond B. Let's add a paper here. Yes, need a paper here. So what will be the change in bond B? Percentage change in PV of bond A will be equals to negative 0.7541 multiplied by 100 basis point down. So negative 1% is equals to positive 0.7541%. If only yield at second year changes by 1% down, the overall bond portfolio value will increase by 0.7541. In PVB, negative 1.6753, negative 1.6753 multiplied by down by 0.75%, positive 1.2565%, and the last percentage change in PV of C, negative 2.599, 2.5990. So it's not only that we will see the higher key rate signifies high change in the bond portfolio, overall portfolio. No, you have to multiply it with the key rate change also to identify what is the overall impact in the portfolio, multiplied by negative 0.25. Earlier what we were saying, that higher the duration, higher is the risk and change. But now the change, that is true if there is a parallel shift. So 2-year duration will have a 2% change, 5-year duration will have a 5% change, and a 10-year duration will have a 10% change for 1% parallel shift. Now the curve is not shifting in a parallel fashion. So we have to consider both things, duration as well as the change in the yield of that respective time also. So now what will be impact in the bond value? 2.5990 multiplied by 0.25. So here in this case, bond portfolio value will increase by 0.6498% only. What we should be doing? As a portfolio manager, as an investor, you should be shifting your investment from bond C to bond B to increase or maximize your returns. Maximize your return. And now we have considered both things, duration as well as change in the yield at respective timing also. When we were making decision based on only duration, yields are expected to go down, invest in a high duration bond. Yields are expected to go up, either withdraw everything or withdraw or invest in a low duration bond. Assuming all bonds, small tenure, long tenure, short tenure and long tenure, all will change at the same, all will change with the same yield. यहाँ पर in duration के साथ में हमने yield भी consider किया, because yield is changing with a different value at a different point of time. This helps your fund manager, investment manager, or an investor for making decision where he should shift his investment from where to where, from which place, which bond to which bond, next bond, to increase his return or decrease the losses, if any, going to happen. So next part, the one more illustration. Table for expected shift in the yield curve for 1, 2, 3, 4 year is as follows. Now here the yield are increasing. At 1 year tenure, yield is going to shift by up by 100 basis point, then 125 basis point. So it looks like it's the original yield. Now the new yield will be like this. At a shorter tenure, the yield is changing by 100 basis point, but as the time moves ahead, the change is also going more up, more steepness is coming in the rate as with respect to time. Now we have a portfolio of bond A and B. Maturities are already there, coupon rate etc. are not given, so we are not calculating modified duration. Direct key rate duration is available with us, and the market values are also available with us. So if market value is there, we can calculate the weightage also. Calculate the percentage change in value of both bond individually. So if percentage change in PV of bond A is equals to PV is equals to percentage change in PV is equals to minus key rate duration multiplied by change in RK. So percentage change in PV of A is equals to negative 1.504 multiplied by, which this is having a yes, key rate, and this is having a tenure of 3 year. So at 3 year, bond yields are increasing by 1.5%. So overall bond portfolio value will go 1.504 multiplied by 1.5 is equals to 2.256 negative. The bond portfolio value will go down by 2.256%. Next, in PV of B will be equals to negative 2.308 multiplied by 4 year, it's going up by 2%. So it will have an impact of 2.2308 multiplied by what 2 is equals to 4.4616%. So this is the effect of each bond in the overall portfolio. Overall portfolio. Calculate the percentage change in overall bond portfolio value. Percentage change in overall bond portfolio value. So we have individual change. Now we can calculate the overall change. How to calculate overall change? How to calculate the overall change in the bond portfolio value? It is change in the percentage change in overall bond portfolio value is nothing but as your sum of these two changes, 2.56% plus negative 4.4616% is equals to 2.256 plus 4.4616 is equals to negative 6.7176%. What is the overall bond portfolio's duration? It is the sum of your key rate duration, 1.504 plus 2.308. The weight effect is already there. So it is the overall bond portfolio duration is 3.8120 times. This represents your overall effective duration of the portfolio. So if yield is changing at 3-year time by 1.5% and at 4-year time by 2%, the overall effect, the non-parallel shift, the overall effect will be 6.7176% on your overall bond portfolio. Why we have not considered these market values? Market value are already considered in calculation of key rate duration. How we have calculated key rate duration? It is the weighted multiplication of weight multiplied by the modified duration. So weight is already multiplied. Weight is based on the market value. So weight of 0.25 and 0.75 is already reflected in these duration, key rate duration of 1.504 and 2.308. So we need not to worry about that. So let's say if the yield curve goes for a parallel shift of 1.5%, parallel shift, what will be the impact? The parallel shift impact will be 3.812 multiplied by 1.5, 5.7%. If it changes by 2%, parallel shift, it will be 3.812 multiplied by 2, that is 7.62, and we are getting somewhere in between. Now question comes whether we should stay invested in these two bonds. Of course, no. Since the yields are going up, the impact on bond portfolio will be negative. We should withdraw if it is possible, from both the bonds. But many times it is not possible. So if we want to stay invested, how to minimize the loss? We can minimize the loss by shifting from bond B to at least bond A. So I hope everyone understood how key rate duration is very critical risk measure for fixed income investors, because it helps us to identify shifting of your bond portfolio from one investment to another investment. Next part is your empirical versus analytical duration. We only have a difference, not calculation. We cannot, because we are not having statistical model in our course. So what is the difference between analytical and empirical duration? Analytical duration include everything, whatever we have done, Macaulay, modified, effective, and key rate. So the major difference is analytical include mathematical formula, and assumption is that the third limitation, which still stays with the key rate duration. Yield duration has 3 limitation. Curve duration has 2 limitation. Key rate duration still has 1 duration. 3 limitation, cash flows are certain. Yield duration. Second, 2 limitation left, including your parallel shift improvised by key rate duration. Now that third limitation, that the benchmark yield and spread are not correlated, still there with the analytical duration, even with the key rate duration. But historically, during the stress period, recession, etc., First of all, what is empirical duration? It uses historical data. So it is having a problem. It is backward looking. So historical data, it uses historical data in the statistical model, incorporating various factors, not only the interest rate changes, absolute interest rate changes, but other factors also. So this is more refined way of calculation of duration, sensitivity. Why we need, first of all, why we need empirical duration during crisis, stress period. And during stress period, investor would like to hold government security in comparison to corporate bonds. So what they are going to do, they are going for selling the corporate bond if they are holding, and go for additional demand for generate additional demand for government bonds. So investor typically sell risky asset, that is corporate bond, and purchase government security. And this is called as flight to quality. This particular phenomena is called as flight to quality. स्ट्रेस आया, डर आया, कुछ तो दिक्कत है, तो जहां रिस्की में इन्वेस्टेड थे वहां से भागेंगे, और जहां रिस्क लेस है वहां पर जाने की कोशिश करेंगे टू अवॉइड रिस्क. दिस इज द नेचर ऑफ इन्वेस्टर, रिस्क एवर्स नेचर. So this will create a flight to quality, can cause government yield, benchmark yields to fall. Why benchmark yield will fall? Because when everyone is going to create a demand for government bonds, the prices will go up, yield will go down. Inverse relationship. While credit spread will widen, because there's a stress period, crisis. Corporates will be facing difficulty in payment. So credit risk will increase. Accordingly, credit spread will widen. So there is a negative correlation. One side benchmark yields are going down, at the same point of time the corporate spread, the credit spread is going up. What is yield of bond? Yield of bond is equals to benchmark yield plus spread. And this represent a real RF, risk-free return, and inflation premium. This is for multi-type of risk: liquidity, then credit, then your maturity risk, then your tax factors, etc., etc. So here what we concluded, in case of stress period, specifically in that period, this yield is going down. Because government bonds are in demand, so their prices will go up, yield will go down. Benchmark yield is representing the government yield. And this credit risk is increasing, so the spread is going up. So automatically, somewhat they are setting off each other, offsetting each other. So thus it may conclude that benchmark yield and credit spread are negatively correlated under this scenario, specific scenario, when there is a flight to quality. So for government bond, analytical yield and empirical duration, analytical duration and empirical duration will be similar, because both use benchmark yield changes largely driven by bond price. In both, because benchmark yield changes largely drive bond prices in this case, because there is no credit spread. There is no spread in case of government bond, because there is no, we are talking about on the run issue. So there is no liquidity or credit risk in case of government bond. So there will be no additional spread will be there. So in that case, there is no spread. So there is no correlation issue is there. But in case of other bond, corporate bond, during stress market condition, decrease in benchmark yield, government bond yield will offset increase in credit spread. This will result in lower duration, because if yield is, this is going to come, the overall impact on the yield. When we were calculating the Macaulay modified effective or key rate duration, we assume spread is constant. So if benchmark yield is going up, your yield is also going up. Yield of bond is going up, and yield and duration are inversely related. But now in case of when spread was constant, so now if it is going down by 1%, it is going up by 0.25%. Overall effect in the yield is 0.75% negative only. So yield is going down by only 0.75. Only 0.75. So it is offsetting. So it is it will impact duration also. What it is saying, this will result in lower empirical duration than the analytical duration. Lower empirical duration than the analytical duration, because still yield is higher. Earlier it was 10 minus 1 is equals to 9. So now it is still 10.25. So if yield is higher, duration will go down. I hope everyone understood. Since the decrease in yield is less, ultimately yields are higher, assuming spread is also changing. So if spread yield is higher, the decrease in duration, because they are inversely related, is still more than the decrease in duration will be less. That is what it's saying. This will result in lower empirical duration than the analytical duration, because yield is still higher, so duration is lower. Rather than 9, comparing a bond with 9% yield and a B bond with 9.25% yield, the duration of keeping other things will be same. The duration of 9.25 will be low, and this will have a high duration. Analytical will use 9%, whereas empirical will use 9.25. That is why empirical duration is lower than the analytical duration. Increase in bond price due to decrease in benchmark yield is offset by decrease in bond price by widening of credit spread. They are offsetting each other. The benchmark yield that we have already. Conclusion, last. Empirical duration estimate are a more accurate method of forecasting for bond with credit risk. When there is a credit risk, it's better to use empirical duration over the mathematical analytical durations. But it is difficult to calculate. It is more accurate but difficult to calculate, because here you have to assume various factors. Which factor, how much weightage to be given to each factor, whether factor should be considered or not, all things we have to see. Empirical duration estimate utilize historical data based on multiple factors. Now question is, what factors to be used, what weightage is to be given, and how current data is relevant versus the old data, because it's a backward looking calculation. So all these issues create calculation of empirical duration a bit complex. Accurate but more complex. So hopefully everyone understood both the concept, key rate duration and empirical duration. Thank you so much.